Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Bill Blain, who is a strategist at Mint Partners and a market guru, I believe. How are you today, Bill?
I'm grand, tickety-boo, fine, dandy, and all these things you can think about. We had our charity day at BGC Mint yesterday. Fantastically successful day.
Yes, I saw Elizabeth Hurley, Keira Knightley.
I was just saying to them both yesterday how fantastic it was that they could make it once again to our offices.
Fantastic. Hopefully you got lots of phone numbers as well.
We got lots of money raised for charity, which is the main thing.
Yeah, indeed. So keep up the good work on that. That's good to hear. The markets, right, we're in September. It's actually a fairly dull summer. There was a little bit of volatility, but not a huge amount. I mean, if we look back 4 or 5 years ago.
Let's have a little bit think of what we saw during the summer, which I think was probably one of the quietest summers I can remember in 35 years in financial markets. Very, very little happening, and markets moving an awful lot on what was really very insignificant news. Now, you can, of course, argue that Korea testing nuclear missiles is significant news, and it's interesting to see how the market has reacted to the fact that they haven't fired a nuclear missile, and we have the markets and going to a new record level on the US stock markets as a result of that. Of course, you've got some of the Hurricane Irma effect, the fact that it didn't cause as much damage. What we're seeing is classic, very reactive markets. We're also seeing stock markets rising to new records. But if you actually take a look at the charts, it's not a bing, bing, bing. It's a slow, gentle, almost just hitting new highs. These are not well-supported highs. And I think this is a key element to look at. What's actually going on? Why are we seeing stock markets going to a new high? If you look at the US confidence numbers, and you can pull that information out, we have something like a record number, 67% of investors in the US stock market turning around and telling us they are highly confident about the future for the stock market. To me, that is a sign of complacency.
Yes, very much.
And what we think is going on, in fact, what we're certain of, is we are seeing people who do understand the market, the solid understanding holders, are beginning to change their positions. And the reason the market's going out is because you're seeing bonds going from the people who understand it into those who are joining the back end of a rally. Now, there are Blain's famous market mantras. Number 7 is, it's better to miss the last 5% of a rally than to catch the first 20% of a collapse. And it certainly all points to a market that is a little bit over complacent at the moment. And one of the reasons we've got such complacency in the world is the effect of financial asset inflation. Now, I know what you're going to say, Matt. You're going to say, but Bill, there is no inflation in the world. Of course, there's no consumer price inflation. But there has been massive asset inflation. We can see that particularly in the bond markets, where we now have emerging market bonds, countries with the fiscal rectitude of Tajikistan, which is about to launch a bond, I think has actually already launched a bond, which was 5 times oversubscribed. It's a 10-year bond, which would be paying for a dam, a hydroelectric power station dam, that will take 15 years to build and is going to cause all kinds of conflict with its neighboring countries because it blocks off the main source of supply. Yet that bond was 5 times oversubscribed. That's just one signal of what's going on. In the stock markets, we've already described how high they're getting, but you can now look across into other asset classes that are beginning to suffer. One of the alternative assets that we look very closely at is London property. And in prime London, well, you tell me, what do you think the average price in prime London, that's the real centre bit, average price of a 2-bedroom flat?
I'd say it'd be getting near to 1 million.
Getting near to 1 million, you are so wrong. 2.5 million. The cheapest area you can buy in prime London is Soho and Covent Garden, where you're talking about 1.8. But the rental yields on that kind of property is now down somewhere like 2%. We were talking about 3, 5, 6%, and it's come down the last couple of years. Even in the next level out, in core London, as it's called, we're seeing the average 2-bedroom house costing over $1 million, 2-bedroom flat costing just over $1 million and yielding around 3%. These are incredibly low yields, and that's another example of financial asset price inflation, because so many people have been saying, I can't get real returns in the stock markets, I can't get real returns in the bond markets, where else can I go? And of course the reason for this is of QE holding down interest rates at far too low a level. And when you have inflation of financial assets, people have got to think, when is that bubble going to burst?
So what goes up must come down.
Well, so you would think, but the laws of financial gravity are complex.
Indeed. So what will make the asset values go down, the yields go up? Is it simply unwinding QE? And we see kind of chat to the ECB maybe looking at reducing its bond repurchase plan. Obviously, in the US and the UK, obviously a bit further behind. Will that actually reduce asset values?
Well, that's a very, very interesting, I think, a very astute question you're asking. Is one of the key things that we're waiting for is the ECB to start to taper and unwind its buy program. There's all kinds of reasons why it's going to have to. One of the major ones being they're basically running out of things they can buy based on the weightings they can. But certainly we've been getting pushback on them actually making a decision. Last week's ECB meeting told us nothing about timing except we'll do it when we need to. And of course, this has got people worried about the big promise. What is the big promise? Draghi doing whatever it will take to keep European markets strong, to keep the bond market strong so European sovereigns can continue to fund themselves without them being forced to mutualize European debt, which the Germans would never accept. So that's one factor to look at. But in terms of the other over-egged, bubbly-looking, frothy markets, I think you've got to weigh up the other side as well, which is we are now finally, nearly 10 years after Northern Rock, the acknowledged beginning of the real financial crisis. We're now getting to a stage where we do have good growth signals across the world. Okay, it's not stellar growth, but it's growth. We're also seeing more and more central banks moving from a easing to a tightening basis. And at that point, stock markets begin to look a little bit better. And my own view, my own PA view, is very much that if we do get a correction that many people expect sometime in October, my own time is October the 12th, 10:30 in the morning, just in case you're interested.
Take a note of that, October the 12th.
When we get that, I think you wait for that correction and you very quickly then come in and buy at the bottom, because I think that will be sufficient to correct the global stock markets. Global bond markets, though, we've had such spread compression between sovereign debt, subordinated debt and high yield debt and now emerging market debt that there really needs to be a greater correction there.
Understood. Well, on that note, as I say, was it October the 12th?
October the 12th,
10
10:30 in the morning. And ask me why October the 12th, because it's the day before a Friday the 13th.
Understood.
Always a good date for a crash.
Fantastic. On that note, Bill, thank you very much for joining us today.
Thank you.
Very insightful.